worries, and you hit upon it just then. Inflation is definitely a concern. When you're talking about inflation, are we talking about 4%? Are we talking about more than that? And is the Fed going to have to respond much sooner than it thought? And at this particular moment, things look a little shaky. That the economy is heating up faster than people had predicted, and will the Fed have to respond accordingly? And I think at this point, we're a little ahead of ourselves on that. Second thing is the employment numbers, the record number of jobs out there, and there's people who are unemployed, and where's the disconnect? What's happening? Is it that, there's not enough, it's not that there's not enough jobs, but is there enough people to fill these jobs, and are they qualified enough? Or is it that they're still on unemployment, they're still receiving more on unemployment? Which begs another question. Are these jobs paying a competitive salary? Or are we still stuck in the mode of, well, I'm making more money on unemployment, therefore I'm going to stay there? So that becomes an interesting thing at this particular moment. Another thing that I would look to, the markets we're definitely seeing an oversold condition, and a lot, especially in the tech area. That just simply means there's a lot more sellers than buyers at this point. But there's, in the technical talk, there's something called a resistance point, and they're going to reach that resistance point quite soon, because the values of these particular stocks can't be measured just on the numbers alone, from their earnings and what like. So at some point, they're going to hit what's called a technical barrier, and they're not going to go much lower than that. However, I could be wrong, but I have seen this before, and in an oversold condition, things can quickly turn around once we start getting more news and more earnings coming out. So that's another thing that could be forthcoming. It's one thing to keep in mind that, yes, okay, the Fed has indicated that they are not going to do anything at this particular point for out to 2 years out. But if the circumstances and the markets are responding to this rise in interest rates, they're going to be forced to do something at this particular point. I don't think we're going to see that yet. I think that this is an overreaction, by a broad-based overreaction, and that we could see it move back to the upside in quite some time. And I think it's going to happen a lot sooner than people think, because the rationale for the market being pushed down and the pressures that are happening right now are not entirely unfounded, but most certainly overblown at this point. You could be looking for better earnings news, better economic numbers, consumer confidence. There's a slew of information that could be coming out in the coming week that can completely change this. And you want to be on top of that. Yes, the CPI was kind of a no factor at this particular point, because we were comparing it to last year when the pandemic had started. So it's not really a super accurate point, information at this particular point. So we need more information, and that's forthcoming. We're looking for bargains as usual. There's plenty of bargains to be had out there. When you're looking at companies, whether they're value companies or growth companies, if you start to see they're down a certain level, I mean, anything more than 5% as a value or a bottom-up manager, you're looking to buy. And it doesn't matter whether it's growth value or anything else. You want to have that opportunity. And we wait for situations like this. We go in and we purchase positions for our clients. And it tends to work out well because we have a long-term outlook. And if you're short-term, then that's something, a different focus. And if you're a trader, you're usually done by the end of the day. So different focus, different scenarios for guys like me. But overall, the sentiment with everybody that I've talked to, with the other managers that I've spoken to, is that the sentiment is positive, that this will be just a blip on the radar screen. Well, technology is presenting itself as a bargain. We have been looking at technology, tech stocks rising and rising and rising without an opportunity to go in and buy some more at a better price. We love that as value managers. We also like consumer cyclicals. We also like energy right now. Energy and we don't mind fixed income right now. So we're not going out and buying tons of bonds right now, but we might strategically place money with preferred securities and municipal securities if it's the right thing to do, because you can get a quick turnaround in terms of performance if the bonds are pushed down low, and then all of a sudden you see a rise on them. We have made money that way before, and we'll continue to make money that way.